So those are 3 payments. So when we divide 30 million by 3, you get our principal as 10 million. So we shall be paying 10 million every month up to when the loan is complete. So where we see principal, we put 10 million throughout, up to down, and at the very bottom rectangle, we're going to put 30 million. But we're going to start the calculations. Our loan size is 30 millions. The total of our principal is 30 millions, which means by that time we will have paid back all the loan. So to calculate the balance, we're going to subtract the loan size minus the principal. So 30 millions minus 10 millions, which will give us 20 millions. So 20 millions becomes our loan size this side. So 20 millions minus 10 millions gives us 10 millions. So our balance would be 10 millions. So 10 millions becomes our loan size this size. So our loan size minus our principal would give us 0. So this is the reducing balance method, which means we continuously calculate the interest. We're going to keep calculating 5% of each individual loan size up to when the whole column for interest is filled to the bottom. So right now, 5% of 30 millions will give us, that will give us 1,500,000. Okay, so we're going to get 5% of 20 million, that is for the second duration. So 5% of 20 million is 1 million Ugandan shillings. And then we're going to get 5% of 10 millions. This should give us around 500,000 Ugandan shillings. Okay, so our interest, we are done calculating our interest. So now we must total the interest up. So if we add the interest, it must give us a total of 3 million Ugandan shillings. So when that is complete, we're supposed to obtain our book value. Our book value is got by adding the principal plus the interest. So 10 million plus 1,500,000 should give us 11,500,000. So we'll keep doing that for all the columns, all the durations, the first, the second, and the third. So once that is done, we find the total of the book value. We can do this by adding the total of the principal and the interest, or by just adding the column for book value. So that is our loan repayment schedule using the reducing balance method. So moving on to doing the same thing, obtaining a loan repayment schedule using the fixed installments method. So there's nothing tricky to this method. We are going to write our title as usual. Always remember how the format of writing the title, it is very important. It's complicated but worth it. So we're going to the very simple method of fixed installments method. This method is easy because there is almost only one calculation made. So we're going to write our title as we agreed, the business title, then the document and the amount, the interest and the installments, and then the method. So OGS Limited loan repayment schedule for the amount amounting to 30 million Ugandan shillings. Attracting an interest of 5% payable in 3 equal installments. In 3 equal installments. So those are the 3 first columns of our title. So the last column, as we agreed, is supposed to show the method we're going to be using. So we're using the fixed installments methods here. So using the fixed installments methods, the fixed installment method, sorry. So now we're going to draw our table. We're going to fill in the titles as we had done before, the duration, the loan size, we're going to fill in our column with our titles as we had done for the first method. I told you the only difference between these methods is the interest. In the reducing balance method, we keep calculating interest on every step of the way, but in the fixed installments method, the interest is calculated once and filled in once, which makes it the easiest method for creating loan repayment schedules, but it's very costly to actually paying the loan. So those are all our titles: the duration, the loan size, principal, interest, book value, and balance. So we roll that properly. We make sure we get our boxes, our rectangles in there properly. So since it's in 3 equal installments, we make sure our duration counts to 3, and our loan size is 30 million since we're just starting the payment, and our principal is 10 million. We said we get the principal by dividing the loan size by the installments we have to make. So 30 million divided by 3 gives us 10 million in each payment period. So the total of our principal should be equal to the loan size, which is 30 million. So now we're going to move on to the balance. So 30 million minus 10 million gives us 20 million. So to get the balance, we subtract the loan size minus the principal, and then that balance is moved to the loan size of the next payment period. So 20 million is moved ahead. So 20 millions minus 10 millions should give us 10 million. So that 10 million also moved ahead. So that 10 millions minus the principal of 10 million within that trading period gives us 0. So now we're going to obtain the interest. We said interest is obtained once and filled in throughout. Since it is fixed installments, the interest will not change. So the interest is 5% of the loan size. So 5% of 30 million should give us 1.5 millions. So that is 1,500,000. So we fill it in till the end. This is the fixed installments methods. Nothing will change with the interest. There isn't that much calculation, it's just one way. So we say the book value is the addition of the principal and the interest. So even the book value should be constant till the very end. 11,500,000, 11,500,000, 11,500,000 throughout till the end of the book column, the book value column. So then we're going to sum up the interest and the book value. So the total interest should be 4,500,000, and total book value should be 34,500,000. So that should be it. That is our loan repayment schedule for the fixed installments methods. So if you want to know more about loan repayment schedules, please comment loan repayment. So if you enjoyed that video, please subscribe, like, and leave a comment, and hit the notifications bells to get informed on new videos. Thank you.